We are in the third week of discussing about uh, corporate restructuring. So I'll give you a quick recap of what we have discussed as of now for the past two sessions. So corporate restructuring happens when the company finds that it's going to uh, meet a risk, it's going to face a risk in the future. They have a speculation, they have uh, uh, they have known that the company is going to have some risk in the future, nearby future. So to avoid the risk happening, so they are going to make some plans or changes in the existing structure in the sense not the physical structure, but on the functions, on the activities, on the all the business related planning strategy and everything. So not only that, not only because of that reason, restructuring may happen, even for the the companies who are which are doing in a better way. So exceptionally performing companies can also go with corporate restructuring because they want to expand. They want to expand to from the present position to something to a futuristic position, which is much larger than the present one. So that may be the reason. And one more reason can be, the the management which runs the company may find, they are performing few activities or functions, business related activities and functions, few things, which it's unwantedly taking consuming more time, money and energy. So but no, the returns are not quite good. So those projects, they will identify those or those areas in the company, and no, they will try to change everything. Either they will dissolve the project, or they may completely change the the structure of the project. And dispersing completely dispersing a group of individual, I mean group of employees for cost saving. So that is also restructuring. And adding freshers to the company, that is also restructuring. And moving few employees from middle level to the top level, that is in the name of promotion or transfers. So that is also restructuring. So another recently, very recent trend in corporate restructuring is the offsprings or the of the the existing business owners. Like if see Tata, Birla, and you have this Adani, you have many corporates, right? And those who have built the company, those who have dreamt about the company and built the company, so they have developed the company to a certain point. And their offsprings, that is the persons, their children, or the person close to them, when they take up the highest position in the company, when they take up some position in the top management, they want something new. They don't want the all the activities and functions to be happening in the same way as it has happened before, because they want to change according to the the present market. So when they come up with new plans, and for example AI integration, no CRM integration in all the business activities, that is restructuring. And introducing AI, AI related activities or facilities, for faster performance, so that is also a restructuring. And opening up a new plant, a machinery plant, or production plant, offshore plant, and getting merging with another company, that is a form of restructuring. Acquiring another company, that's a form of restructuring. And or this company being acquired or merged by a bigger company, so that is also a form of restructuring. So anything happens in the company, it's a kind of restructuring. And the thing is, restructuring was not given much importance, previously, in the sense 15-20 years back, that's restructuring, it was not much given importance in developing countries like India. It all happened with the Western countries. The restructuring thing happened with the Western countries because those countries were the first countries to adapt to rapidly they adapt to the external change, external trend. Immediately they get adapted. So, but Indian companies, like companies in developing countries like India, it will take some time for them, to understand the change, and then, like slowly, then they will, like slowly get adapted to the change. Because the way of, the work culture, and the way the people do their work, perform their duties here, as in different roles and designations, that's different here from, from the Western countries. That's the reason. So let's go on with the corporate restructuring. And second thing we have discussed is, before implementing the corporate restructuring process, what are all the precautionary methods, the management has to take? First thing is secure the main assets of the company. Secure the main assets, secure the top management, shareholders, the founders, owners of the business. Secure them, because without them, the company doesn't exist. So you cannot replace them. So you have to secure them. Secure the capital, the main capital of the company. You have to secure it. And whatever liabilities, is pending, that is, like the debtors, who are supposed to pay to the company, you should know, like the management has to know, like make them make the payment, like as soon as possible, because when restructuring is happening, so a kind of, like rumor about the company, it spreads in the business industry, it spreads in the industry. So the debtors may not know, like pay back the money. So the management has to make sure that all the monies, all the debts are collected, the capital has to be secured, assets has to be secured, top management has to be secured, and then, and the brand of the company, in the market, in the industry, so that has to be secured. And then go on with slowly implementing the restructuring process, not rapidly, not no like once at a time. It should be, like the transition should be smooth, it should be slow, and it can be done departmental wise. Inform the employees and all the stakeholders that the restructuring is going to happen. So you should inform them, otherwise, no, they'll be in a shock, like they don't know what is happening, like around them. So you should know that management has to inform them, make them ready to know, like to accept the restructuring process. And few employees, like may resist, the restructuring. They may not be, like okay with the restructuring process, so they may resist. Like few employees, experienced employees, maybe like okay with feeding all the information, documenting everything, in physical documents, or they may be using Excel sheet, for everything. Suddenly, when no CRM is coming, and like all the data you have to migrate, you have to migrate it from the Excel worksheet to the CRM data sheet. So few employees, like they may not like it, they may not be, like willing to do it, because they are not ready to learn those things. So yes, sometimes, like in like these scenarios, that maybe, like some resistance. So make those employees understand the need for restructuring, make them accept it, and then go with the restructuring process. Clear? So this is what we have learned as of now. Now let's see. There are other ways to restructuring. Before that, when the restructuring is like happening, or like already happened, or in the process, how will you know, like whether it's a successful one or not, whether like it's like it's working out. All the employees that accepted it, and they are like smoothly, they are like transitioning into the restructuring process. So how will you know, how you will measure the results? So the results of the restructuring strategies, it can be measured by any of the two performance. First one is market performance, or the other way is accounting performance. So what is market performance? So when restructuring is happening, it means the profit should increase, the sales should increase, more revenue has to flow inside the company. So that's why the restructuring is happening, right? The main reason for restructuring will be the cost saving, right? So it should be like visible in the market in the sense the brand, it has to like see the profits. If not immediately it can't be like seen, it can't be experienced, but after some time, maybe 3 months to 6 months, they have to like they have to experience the result, that is no positive result. So if the market performance is doing good, like then yes, restructuring is a successful one. Accounting performance in the sense, like uh, the way the people work within the the company, and the overall cost of running everything, overall running cost of the like the company, carrying cost of the like the activities and everything, so that should decrease. So it shouldn't be like too high. That should decrease actually. So by like comparing these two, by like or with like by analyzing any of these two strategies, the company, the corporate can easily like can have an idea that whether their restructuring process has met the success or not. Now, coming to market performance, the market performance standard addresses the stock price of the organization following a restructuring. That is, the stock prices of the company has to rise, or if the company is not into IPO, they are not into like this thing, IPO thing, then like they have to come up with IPO. So from a normal private company, it has to become a private limited. They should come with IPO, or if it is like a proprietorship company, it has to show some profits. And if it's a government company, that something, like some a good thing has to happen, positive, like thing has to happen. And the changes can be directly attributed to restructuring action or short-term indicators of how the restructuring has affected the organization's performance. And the other way of measuring is accounting performance. That is, to determine the long-term performance, this organization's accounting standards are used to calculate restructuring performance. So comparison is return on investment. So how much they are like taking back with the investment they have made. So how much they have taken back. So how much flow is coming into the company, into the organization. So the carrying cost and running cost, it should like get decreased, and inflow of the cash, inflow of the like the very best resources, that has to increase. So in these two ways, you can measure the result. Then there are various like restructuring ways. There are various ways, not only merging with another company, or not only like acquiring another company, but there are various ways for like restructuring. First one is like sell off. These are all the choices for the management. Okay, like it doesn't mean they have to go with like these, any of these things. It's about like the man. It's all about like how, what the management is deciding. Sell off. Sell off is like it's a sale of a business or subsidiary of the parent company. Sorry. Sorry. So a part of the activity, or part of the business activity, or part of the business function, or part of the assets, part of machinery, whatever, like so, or part of the the company may be having like offices in different locations, maybe like one or two offices which are not doing so good. So the company is not getting any profit out of those projects and those activities, functions, those plans, whatever it is, like if like there is like much profit seen in those business activities, so part of their subsidiary, it can be like sold to the like another firm outside the group, not to the same company. I mean, the company maybe, the parent company maybe having like it's no offspring companies, like in different locations, but the part of the subsidiary, it shouldn't be sold to the offspring companies, but to someone outside the firm, completely outside. Okay, so completely another business as like we is like buying those business activities. So that is called sell off. So what is now achieved by the selling of? Obviously the cash, right? The selling of these business activities, a part of the business activity. So the cash flow will happen in the company. Because the first thing is like the assets and the capital of the company has to be made secured, right? And another thing is, this is the best time to increase the capital of the company. This is the best way to increase the capital. So what they can do is sell off few things, and like they can increase the cash flow. And once capital is like if they feel the capital has like acquired more, and now this is the best time to like again go with the business processes, they can do it. Nokia did this. So Nokia, what they did was like it was like running in loss. They shut down few operations, like few operations, few like manufacturing plants in different locations. of the world, no, like of the world. And what did they do was, but they secured the parent company. Okay, so it secured the parent company. The shareholders were safe, the assets and the capital was safe. So few subsidiaries of Nokia, no, it was sold off to an outsider companies. And no, like once the cash flow, no, like started coming, no, with this sell off thing, and then again, no, they are into business now. So Nokia is the best example. So let's see, no, like what are all the points, no, to be noted in this sell off thing. Strategic buyers are those who are interested in acquiring a business for strategic purposes, that is increasing the market share. So here the decision making completely goes off because you have the sold, no, you have sold the subsidiary to completely different companies. So the decision making about that, those subsidiaries, no, which you have sold off, so it goes no out of the hand from the top management. So increasing market share, reason for no going for sell-off, creating economies of scale or exploiting synergies. So they are typically companies engaged in the same business as therefore competing with the business or company under consideration. And in contrast, financial buyers or those who are interested in acquiring a business to secure a financial return in the short to medium term before selling the business or otherwise exiting the investment. So this is the best choice, no, for the companies. Financial buyers are likely to be buyout firms. So these buyout firms, no, like they usually, know, like they keep on buying these companies which are going on with sell-off. There are companies, no, buyout companies, no, like in the business industry. They don't do any manufacturing. They don't do no like any. They don't own any assets. All they do is they wait for the opportunity, no, like for the companies to know like go with sell off of their subsidiaries. And when a company is doing that, they buy it and then sell it to another company. Okay, so these are the buyout firms. And buyout firms generally focus on established companies with potential to grow after transformation. So non-core divisions and subsidiaries of large public companies are their typical targets. So their typical target is the large public companies because that's where the sell-off can happen because those large companies cannot manage the large scale operations. It's difficult for them when they are expanding, like it's difficult for any large scale company to manage all the operations all over the world. So you normally know like these large scale companies, they try to sell off few of their subsidiary company to like someone outside. And there are buyout firms to buy these like subsidiary companies or subsidiary activities, and they like resell. Second way for restructuring, like going with carve out. Remember, all these sell off, carve out, and like few more things are coming. So all these are for increasing the capital, increasing the cash flow, into the company for like increasing the capital. So equity carve out is a sale of an equity interest in a subsidiary to public investors in an IPO. So that is like carve out. This is normally called as equity carve out. Or to professional investors in a private placement. Equity carve outs come in two forms: minority carve out and majority carve out. So minority, okay, that we will see later. What is minority and what is majority? So equity carve outs is the company has introduced an like equity, and few equities they are ready to sell. They are ready to like sell it to like to those buyout companies or to those like individuals who are ready to buy these carve outs. So what's so like good point in this is the brand name will not be like the I mean it will not be like agitated. So it remains the same, and the brand value remains the same. So that will not be a problem in the market or in the industry. And only when the company decides to go with the majority carve out, then there is a small problem. The problem is the decision making thing. So as long as the company goes for the minority carve out, there is no like only few minor shares they are ready to sell. So that is fine. But no, when they are ready to sell the majority carve out, that is no like major shares, no, they are ready to like sell. So then there is a problem. Then the thing is decision making. So when majority carve out is happening, decision making cannot be done by the parent company. So because it is already sold. So minority carve-out occurs when a parent company sells a minority interest in a wholly owned subsidiary to investors while retaining the majority interest. And a majority carve-out involves the sale of majority interest in a wholly owned subsidiary to investors. It should be noted that the preparation for either an IPO or a private placement to professional investors takes longer than that for the sell-off. So it takes more time than the sell-off strategy. And in addition, a parent company will have to ensure that a carved out subsidiary should be a viable independent company. It should be a viable independent company because everything is cut out, right? Once the sale happens, so that's completely cut out. This is often the most difficult part in the preparation for an equity carve out. So they have to decide, what shares they have to go with for, for this carve out thing. So what shares they have to select as like the minority things, minority activities or share values, so that they can go for this carve out. So that is only the difficult thing. So the main benefits of minority carve out is parent company continues to remain in the control of the subsidiary. It allows the parent company to take advantage of a high valuation of part of its operations and provides opportunities to raise capital on advantageous terms. And if the minority carve out unlocks value and a higher rated or higher value stock is created, the stock of the parent company has more value as an acquisition currency. So after the carve out has happened, the remaining IPO, the remaining share value of the company, if it increases, then it's a major jackpot to these to this parent company. It gives the subsidiary time to become a stronger company before a sale or majority or full carve out. So instead of going for majority carve out, the company can start with minority carve out, uh, wait and see whether it's working or not. That is, the company is able to make profit or not. The capital can be increased or not. And if that doesn't work, then they can go for the majority carve out. It may create business opportunities for the subsidiary by demonstrating that the subsidiary will be an independent business. So whatever they have sold, that's an independent business. And a minority carve-out IPO allows the subsidiary to offer market-linked or other equity incentives to management. What are all the disadvantages? Parent company maintains control of the subsidiary, which may cause a potential conflict of interest with the minority shareholders of the subsidiary. So that is a conflict, right? Because still the decision making is in the hands of the parent company. So there may be a conflict. And if the initial public float is too small, it may fail to attract institutional investors. So after the carve out has happened, but the share value of those carved out shares, it has not increased, then there is a problem. Small public floats may increase the volatility of the stock, and in difficult markets, a minority carve-out may impede a selling strategy by setting a price for the shares of the subsidiary which is below their real value, because there is no other choice, right? So they have to go down with their from their real value. A minority carve-out may reduce the flexibility with which the parent and the subsidiary can cooperate to capture synergies. But most cases it doesn't happen. So it's always better for the parent company to remain silent. That is not get too much involved in those subsidiaries or in those shares which has been carved out. So it's better to not to get involved. Now, next is the parent company should anticipate that a minority carve out is often an interim solution. That is, it's just an interim solution and not a permanent solution. And in most cases, the minority carve out is later followed by another transaction, such as a sell off, follow on public offering, or spin off. If minority carve out doesn't work, then the company can decide for sell off. And if that doesn't work, then they can go for majority carve out. In practice, a minority carve out is likely to lead a complete separation over time. It happens because the carved out subsidiary tends to drift away from and interact less with the parent due to its independence. In addition, the carved out subsidiary, if it becomes publicly listed company, You have no, the company has sold few of its no like minority shares to another company, and if those companies which was bought these minority shares, if they have become a no like a publicly listed company, so those shares, what have it happened to those shares? So it will issue its own financial statements and establish a public market value, resulting in the increased possibility of a merger or takeover offer. So those companies know like they will know they will completely become no like on their own. So now they can know separately know like they can submit their financial statements. They don't have to depend on the parent company anymore. A minority carve-out IPO may be combined with the later spin-off. We will know like discuss what a spin-off. If unsuccessful, minority carve-out may be followed by a spin-in. That is, the parent company acquires the shares held by minority shareholders and turns the majority-owned subsidiary into a wholly owned subsidiary. So there is a still there is a chance for this parent company to take back those minority carve-outs, no, to from those agencies or individuals, no, to whom they have given. So still though they have that thing. But in majority carve-out, that doesn't know, like that doesn't happen. When a substantial or complete separation is desired, majority carve-out may be implemented. Again, usually by way of an IPO or private placement. When majority carve-out happens, so what are all the benefits? So majority carve-out may generate substantial cash because major shares has been sold off, right? So definitely it will generate more cash, increase the capital to know the to highest level for the payment and subsidiary. A majority carve-out may allow the parent to terminate its responsibility towards a subsidiary, and that there will be fewer potential conflicts because completely no major of the shares has been sold off. So there is no need for conflict at all because the parent company cannot now no they cannot involve in decision making, right? So there will be fewer potential conflicts. Notwithstanding that, it will only be a minority shareholder. The parent may maintain a significant influence on the subsidiary after the carve out. So what are all the disadvantages? Disadvantages, no, like neither the parent nor its shareholders will participate fully in the upside of the subsidiary, and the parent will lose control over the subsidiary after the carve out. Then comes the spin-off. One second. Yeah. So what is a spin-off or demerger? That is no, the main company splitting into two. That is no like spin-off, or it may split into three. Because no like they cannot handle the like overall operations. It is difficult for the management, or without their influence, no, somehow the company like started expanding rapidly. They couldn't control it. It has just started expanding rapidly. So somehow no like they have to know like split the whole activities no into no like different departmental wise activities. So then comes the spin-off. For example, no, like when Microsoft was no like found, or IBM, or this Google, no, like when these companies know when they started growing, after they have reached their no like their the maximum growth. Now these companies know like they have split into no like split into in the sense spin-off has happened. That is no like one particular no like team from a subsidiary from Google, no, it is completely focusing on no like what do you say, no, AI and everything. And another spin-off from Google is no like completely focusing on no like what do you say, quantum computing, no, like so there are more spin-off because since the company has no like expanded to a no like a maximum thing, all the operations no like all the overall operations no cannot be controlled by one single management. So after the spin-off has happened, so can be no managed by different managements. So each and every spin-off will have their own management, but the main control will be no the parent company. So it's a kind of a demerger. So spin-off often consists of the distribution of a subsidiary stock to the parent company's existing shareholders by way of a dividend. A spin-off is a popular way of undertaking corporate restructuring in the US and Europe. So when it comes to know like like generating cash, the parent company. So, like by the way of dividend, it pays off to its shareholders. The main reason for the popularity of spin-offs is that distribution can often be made tax-free for both the parent corporation and the receiving shareholders. Even in India, no, we receive no like this dividends. So if you have invested in no like mutual funds or no like in shares, after some time, no, you will receive dividend no from the companies because they are exceptionally doing good. Because they are expanding, those companies are no like doing good in the industry. Their profits are no like really high. So but they need some no like control over no like the operation, so that's why no they go for spin-off. So what they do is they distribute the profit in the name of dividend. The main reason for the popularity of spin-off is that that we have seen because it's completely tax-free. Spin-offs are a means to unlock the value of a subsidiary and transfer that value directly to the parent's company's shareholders. It is especially useful for the subsidiary that does not completely fit with the parent company's core activities or would otherwise benefit from being a standalone public company. So it is no like exceptionally useful. No, like when this spin off the company, no, the subsidiary company, it doesn't fit with the parent company's core activities. Now the core activity of no the Google is no uh, to create no like more user interface models and everything, right? But what about this quantum computing and all? No, like so that activity is no like different in the sense it's related to the no like all these no like the main uh, components and things, but that's not the complete activity which has to be no like managed, monitored by a different management, different people no who are specialized in that. So that's why no the spin-off is happening. And after some time, no, those spinned off subsidiaries, no, it can become a standalone company, no, after some time. So spin-offs are also a means to obtain full value of the parent company's shareholders. When a spun-off subsidiary is viable but will not command a reasonable price in cash divestiture because of the market conditions. But if, even after the spin-off, the spin-off subsidiary, if it is not performing well, they don't have to worry because even now, no, they are still no like attached to the parent company because they haven't gone out. They are still no like the offspring of the parent company. So the shareholders of the parent company can help these not so performing spinned off subsidiaries. Where the shares of the parent company are publicly listed in order to ensure that the parent's company shareholders can realize the value of the distribution, the shares of the subsidiary generally need to be publicly listed to give the shareholders the same liquidity in the shares in the subsidiary as they have in the shares of the parent. So that is, the parent will need to seek a public listing for the new shares. So they have to go with no new, but they couldn't no acquire back all these things. As is the case with equity carve-outs, the spun-off subsidiary must be a viable standalone entity to create a shareholder value. This means that it must have a strong capital structure and a viable business model because once this spin-off happens, so it has its own management, and so if they want, they can no go with their own no like capital structure and everything. And this poses a major challenge for all the spin-offs. But after some time, no, like these spin-offs, right? If they are exceptionally doing good, if they are not doing better than the parent company, then there is no like uh, there is a chance, no, it may become an independent company, standalone company in the future. They may know like cut out, no, like cut themselves, no, from the parent company. That may also happen. Sorry. So in addition, spin-offs have no like few disadvantages. There is not like equity carve-out or sale for cash. Neither the parent company nor the subsidiary receives any cash in the transaction itself. The parent company loses the income and cash flow of the subsidiary without receiving any cash in return. Unlike a carve-out IPO, the shares are distributed to the parent shareholders as a dividend, not to know like the the public. So it's not like given to the shareholders, no, the parents' shareholders as a dividend, and therefore The parent company may not work hard to create investor interest in the stock as much as in a carve-out IPO. If the spun-off subsidiary fails to meet their investment criteria, that is minimum size of market capitalization, institutional investors of the parent company may sell the shares distributed to them in the spin-off to generate capital, to generate more funds, no, to support these spun-off subsidiary companies. So carve-out IPO may be combined with later spin-off. So the company, see, there is a rule, no, like not a rule. Not all the companies go with only one strategy. No, they don't take up just one strategy. No, only spin-off or no, like only equity carve-out. They know like go with multiple restructuring processes. When spin-off is happening, no, like on one end in one of the subsidiary company. I'm sorry, and in another subsidiary company, the carve out may be happening. So this is possible actually. Uh, all this is to know like generate more funds, no, increase the capital, increase the brand value of the company, capturing the market, and like having a competitive advantage, no. So for all these things, no, the companies mostly know they keep on going with these restructuring process. So previously, when restructuring was happening, there was a definite timeline. So the start time and the end time, or start date and the end date. But now it is a trend that there is no end date for no any restructuring process, because it's a continuous process. Companies know like do this, no, like almost like on a daily basis, because every day new strategies has to be laid out, new plans has to be laid out, it has to be executed, new projects has to be kicked off, and like many things is happening, like to sustain in the market, to sustain in the industry. So restructuring happens in every corporate, like restructuring happens, and they don't just go with one restructuring strategy, they go with multiple restructuring strategies. It all depends on the management's decision. So like if shareholders are like very supportive, so restructuring is a successful one. So disadvantages is the IPO is dependent on equity market conditions. Obviously, preparing for and implementing the IPO is time consuming. Companies with small public floats are less attractive to institutional investors, because initial days, their IPO value will not be, like too higher. So it may, like seem like, less attractive. A depressed stock price may prevent the parent from undertaking the subsequent spin-off. So this is also possible. But most cases, no, the shareholders, the parent company tries to save those spun-off companies. No, mostly, no, in most cases they will try to save those spun-off companies, those subsidiary companies, by investing more, by adding more shares, like transferring more shares. They will try to save those companies. Then is the spin-ins. Spin-ins is companies are making majority owned subsidiaries into wholly owned subsidiaries. That is taking back whatever is given. So that is spin-in. So again, it increases the capital. So the company goes for spin-off, separates the company, separates the whole functions, or separates like few factors, and as subsidiaries. And when these subsidiaries, when they are performing good, and their share value has increased, and before they like they cut themselves from the parent company, this parent company can like take back those spin-off companies. So that's called spin-ins. Such transactions are referred to as spin-ins. Often, spin-ins are implemented through the share exchange procedure. This allows a parent company to implement group-wide restructuring by streamlining overlapping businesses and redeploying assets and capabilities within the group. Consequently, spin-ins will often lead to divestitures. So then spin-ins, that is not taking back the spin-off companies, spin-in happens, and then then they go for divestitures. Now the brand value and like the capital, everything is increased, right? Because of the spin-ins, because they have taken back whatever is like whatever they have given. So now they can go with divestitures. They can go with more product line, or like they can expand their operations, like in other countries, other locations, newer locations. They can go with merging, they can go with acquisition, whatever they want, they can do. They can do it. Split off and split up. So these are other two strategies, for restructuring process. Split off is a variant of spin off. Split off is a variant of a spin off. So in split off, a parent company distributes the shares it owns in a subsidiary to its shareholders in exchange for their shares of their parent. In spin off, their exchange for share, that is not happening. But in split off, exchange for the shares, of the parent is happening. So that is the only difference. Split off is a way to create value for the parent's shareholders by reducing the parent's outstanding shares. Reducing the parent's shares outstanding increases the earnings and cash flow per share, and thereby the value of the remaining shares. A split up is a form of split off. So it's a form of split off where a parent company is broken up into two or more independent companies. So independent companies in the sense completely, management is completely different. So a new management. So taking decisions on their own. So completely split up. In the split up, a parent company is often liquidated. That is, the capital is liquidated, and the parent company's shareholders become shareholders of each of the new independent companies. So to whom it is sold? To the shareholders itself. So that's the difference between split off and split up. Okay, so we have one more PPT. Right, I'll no share that also. Yes, we have here. Yeah, visible. Okay, visible, right? Okay. Okay, fine, thanks. Okay, so corporate splits. Um, we have seen about what is split and split up, split off and split up. Corporate split, whether it's good or bad for the company, it completely depends on why the management is taking this decision. For what reason they are not taking this decision, whether to increase the capital, or the capital is already more than required, so they don't want it to lay idle. So they want to go for divestiture, so invest in more activities, or for newer trends, and to or they may invest in R&D activities. So for what reason they have not taken this um, choice of whether to go with split off or split up. So the corporate split procedure makes it easier for companies to split business units into new companies, that we have already seen, because when the split up happens, completely independent companies will be formed. So who forms these independent companies? The shareholders. Prior to the introduction of the corporate split procedure, it was possible for a company to split a business unit into a new subsidiary through either an investment in kind or a post-establishment transfer of business. So either the establishment happens, either before the establishment happens, or after the establishment of the new company happens. However, the traditional methods to complete such transactions were expensive and time consuming. So an asset valuation by a court appointed inspector was required. So because it requires more time, right? So same way, traditional methods of split of it involved more time and more procedures. So a corporate split which does not involve the distribution of shares directly to the shareholders of a transfer or company enables a parent company to focus on core business, because now they can concentrate on the very core business, because the other business activities which are not fruitful, which are not gaining any profit, or which cannot be controlled, those has been given off. and improve the control span of the parents' management team by reducing parental involvement and accommodate differing personnel and compensation systems. So because new management, so they can go for newer set of employees. At the same time, such splits enable a parent company to unlock the value of a business unit by clarifying the business unit's responsibility and authority, providing a certain degree of autonomy to foster an independent culture, expediting the business unit's decision making to improve business performance, and enhancing visibility for customers, suppliers, and potential alliance partners or buyers. So, all this can be done in split off. So, clarifying the business unit's responsibility, so giving them idea about their responsibility and authority, and providing a certain degree of autonomy to decision making purpose, and to have an independent work culture, business culture or organizational culture, expediting, like making the business units decision making faster to improve business performance, and enhancing the visibility for customers, suppliers, and potential alliance partners or buyers. So, in the market, all the stakeholders will see those split off companies as a newer company. So they see it, like completely different. They don't know, compare it with the parent company. More significantly, corporate splits facilitate the participation of strategic partners who can provide necessary capabilities. So tracking the stock, how will you know, track the stock? So you have done a split off or spin off or whatever, the management has done, for securing the capital or to increase the capital. So they have done with the restructuring process, or they are in the process of restructuring. So how will they know, track the stock? Tracking stock is a class of a parent company common stock that provides a return to investors linked to the performance of a particular business unit within the parent company. So this is necessary, before the shareholders makes the decision that whether they have to go with, buying back spin-ins. So before going for spin-ins, so they have to go with tracking the stocks. So in theory, tracking stock can create many benefits for both the parent company and the subsidiary. One second, let me stop this. Okay, sorry for the disturbance. So the second point is, in theory, tracking stock can create many benefits for both the parent company and the subsidiary. A tracking stock does not require the parent company to make a tax, legal, governance, and organizational changes required for an equity carve out. So it doesn't need the parent company to make decisions on these matters. So no separate board of directors is required, and this provides the main appeal to the parent company over other alternatives. And one thing has to be noted is tracking stocks are often terminated when the circumstances and objectives of the business and or parent company change, and consequently parent company decides to sell, spin off, or spin in the tracked businesses. So tracking stocks, it can be done before the deciding whether to go with spin off or carve out and everything, or after that is done, after the carve out, after the spin off, after the split up, not split up, sorry, split off. So after these restructuring strategies, tracking stock, can be done. So it shows the actual value of the company, the market value of the company, and if it is satisfiable, then the company can go on with the core operations, concentrate on their core operations. But if it is not so, the share value is not so, convincing, the stocks value are not so convincing, then they can go for the spin-ins because that is the only option they have. Because they again cannot go for like spin-off because already the spin-off has happened or already like this minority carve-out has happened. So if they want to take decision to increase the capital or cash flow, the only way they have to do is either they have to go for majority carve out, then there is a problem. Decision making will like go out of hand. And when they go for this split up thing again, completely like the whole parent company is like split into the many companies and individual companies are formed. So in either way, it is a like a big blow to the parent company. So to avoid this, they can go for spin-ins. If they have gone for spin-offs, then they can go for spin-ins after tracking the stocks. So advantages to using tracking stocks include parent company continues to control the business and maintain ownership of its assets. Tracking stock can raise capital on attractive terms. Publicly listed tracking stock establishes a market value for the business to which management compensation programs can be tied. The tracking stock preserves the operating benefits of a single integrated corporation, and the parent company may use the tracking stock as an acquisition currency. So it can be used as an acquisition currency. So what are the disadvantages? Parent company issuing a tracking stock must create financial firewalls between the business and the rest of its operations, because if if the information goes out that the company is going for tracking stock, so it means the company is vulnerable. No, like it's like what do you say? The- it means the company has become so vulnerable in the market. The bigger companies can make any decisions to merge this company or acquire this company. So this tracking stock information, that the company is doing, the parent company is going for tracking stock. So this information shouldn't go outside. It shouldn't go outside of the business. It shouldn't go to the market. So none of the stakeholders should know this. The other restructuring thing, yes, the public can be informed, the public can know, but this tracking stock, this shouldn't be sent out to the outside the company. Why? Because it creates a vulnerability, in the company's activities and all the other aspects. The parent company will shoulder the administrative burden in connection with the tracking stock, and the company that issues a tracking stock creates a potential for a conflict at the board level between the interest of the two sets of shareholders. So that's why this information shouldn't go out. Sometimes few companies, the founders or the the main investor of the company, sometimes they don't even know make their shareholders know that they have decided to check these, they check their stocks value and everything. uh, See, having an overall stock value, so that is very easy. So if a company is going for IPO, and they have given out at least 10,000 IPOs as of now, and tracking the share value of each unit, that's very easy. But after the spin off has happened, after this split off has happened, or after this minority carve out has happened, when the company is going for tracking stock, it means the management is still doubtful about their process. So that's why this information shouldn't go outside the company. Investors may not give as much value to this tracking stock as if shares represented a direct ownership interest in the assets of the tracked business. Okay, the next strategy the company can go for restructuring is joint ventures. And Maruti is a company, Suzuki is a company, another company from two different countries. So they jointly formed Maruti Suzuki. So that's a joint venture. So it's again a restructuring process, an expansion process. When well crafted, joint ventures can achieve many of the same objectives for the parent company as an acquisition of the other company. So it includes access to the resources and capabilities of the joint venture partner, but at lower cost and without many of the risks associated with an acquisition. So it means Suzuki will share all the technology, all the like required machinery, or like all the few required components, for all the products of Maruti Suzuki. And like Maruti also can support with like making engines and whatever, like, so they both can support these joint venture. The main advantages of going with joint venture is the individual companies which has like gone into this joint venture. So individual brands, it can be saved. Their brands will not like go off, tear off. So that can be saved because when Maruti and Suzuki, like jointly, like came with Maruti Suzuki. Maruti as an individual entity, it was still functioning, and Suzuki as an individual entity, it was still functioning. They both had like their own share value in the market. So this doesn't affect their share values. Okay. So a joint venture is like completely like a new company coming up with a new product, or it can be a new technology or new innovation, whatever it is. Like, so it's always a good thing to go with joint venture. Consequently, the parent can increase the value of the subsidiary by way of a JV. Successful JVs are often followed by IPOs. It may also be used as a means of divesting in a business, like going for a divestiture. The first step, creation of a JV, that is joint venture with a strategic partner. So often the strategic partner controls the major stake, that is over 50% in the JV company. That is, if Maruti and Suzuki joins hands, so either Maruti or Suzuki, it should have more than 50% of the major stake. The second step is the acquisition of the minority shares of the joint venture company by the strategic partner. Such two-stage transactions provide the acquiring partner with benefits, that is, a means to encourage the partner to assist in building the business. So both join hands to build the business of Maruti Suzuki. Still, Maruti Suzuki has its own management. Decision making is done by the management of Maruti Suzuki. And for other, like higher decision making matters like strategic planning, both the companies know like they can give ideas, suggestions, they can input some money into the business. A means to get to know the business before a subsequent acquisition, and a means to lay the groundwork for smooth integration after a later acquisition. So buyout firms are active buyers of non-core subsidiaries of large public companies. Advantages of buyout partnership. This is a means to encourage the partner to assist in building the business. Experienced buyout firms can greatly assist in building the subsidiary recruiting management. Buyout firms invest cash into the subsidiary and assist in funding key business initiatives. Involvement of experienced and respected buyout firms may be significant asset to the subsidiary in a later IPO. And the two challenges for buyout firms is buyout firm may not invest in an entity when the parent company is in control, because these buyout firms they want the ownership, the complete ownership in their control. They want all the control of those subsidiary companies which they are buying. So if still the parent company like is controlling these subsidiaries, then these buyout companies will not buy it. And buyout firms are usually interested in executing an exit strategy within a reasonable time frame. So these are the like few other points I have mentioned related to this corporate restructuring. So with this, this restructuring session gets over. Remember these 3 points, okay? Like restructuring, it involves like all the stakeholders in the company. It doesn't involve government. It doesn't involve government, but it involves all the other stakeholders. Because decision making is like primarily taken by the top management, and the players in this restructuring process are the top management, the employees of the company, the buyout firms, and the individual establishments, like when they like buy these spin-off companies and the split-off companies, and shareholders, mainly the shareholders, to whom the majority shares are being given off as a split up procedure, split up strategy. So these are the main players in the restructuring process. And yeah, as I discussed, as I mentioned earlier, nowadays all the corporates are in the process of restructuring. Like it may not be shown outside. It may not be visible from outside, but within them, within the management, within their core business activities, restructuring is happening. So yes, if you have any doubts, you can ask. I'll stay here for another say 5 minutes.